Hey, everybody out there. We are back with Mark Collinsworth of the Vera Global Wealth Financial Management Company, an expert on the finances. And today's topic, appropriately enough, is the latest Fed interest rate hike, this time 75 basis points, which translates in layman's terms to 0.75% hike. So, Mark, welcome back. And how significant is this? Again, to the layman like myself, 0.75% doesn't sound like much. How much of an effect will it have, and on what?
Well, in normal times, it would have a big impact, but the inflation rate is so much above the Fed funds rate. So after today's hike, the Fed funds rate's at 2.5%, inflation's running at 9%. So inflation has the upper hand. And what's got the market kind of running up now, the market had a huge up day because there was a rumor going around that it was going to be 100 basis points instead of the 75. And the market's only anticipating another 100 between now and the end of the year. That would only put you at 3.5, and 3.5 still doesn't even. At 3.5, you're just beginning to put a dent in the inflation rate of 9.1.
So therefore, inflation will probably continue for some time.
Correct. It won't come down quickly unless the Fed gets much more aggressive on raising interest rates.
Okay, now my actual question though was that in terms of how it's going to affect the average person in terms of credit cards, mortgages, car loans, et cetera, anything that you're buying on credit, how big a hit will that be for the common average consumer, average American?
Well, depending on how much credit card debt you have, it could be a lot. But the interesting thing about that is even though they raised 75 basis points today, consumers might not see it turn up on their credit card for another month based on the billing cycles of the credit card companies.
But when it does come in, the upgrade, the uptick, like let's say on a $10,000 loan, how much of an impact would it have on your monthly payments?
It can actually be a lot. And the reason why I can't give you a specific answer on that is because the Fed funds rate kind of only gives a guide. So even though the Fed funds rate by the Fed went up 75 basis points, that's not stopping your bank from actually raising your rates 100 basis points or even 150 basis points. The Fed funds rate is just a guide to the direction of banks.
So the banks and credit card companies usually, normally, do raise it beyond whatever the Fed raises. If the Fed raises it 0.75% of 1%, the banks and others won't go along with that. Usually they go higher than that, is what you're saying.
Correct. And I give you a really great example. When the Fed actually cut the Fed funds rate down to 0.25, I think the lowest your mortgage rates went was about maybe 4%, 3.5%. So they got nowhere near where the Fed funds rate's at. But now that the Fed fund rate's going up, mortgage rates are going up.
So what we're going to have here in the next billing cycle on people's credit cards or whenever their payments come due, they're going to be paying more on their loans and any kind of debt. But at the same time, inflation is going to continue rising for some time now, right?
That's correct. So, like at the gas pump, basically for every 10 to 15 cent increase in the price of gasoline, that's the equivalent of a 25 basis point increase in the Fed funds rate. Has basically the same effect.
So this is a double whammy again on the American consumer. The higher prices are going to continue getting higher, while at the same time you're paying more to pay off any kind of debt that you have, any kind of loans that you have.
That's correct.
So, how soon would the turnaround be? And then what would the effects be when they finally start stalling inflation? Aren't they also going to stall the economy generally in terms of jobs and everything else?
Correct. So right now, the big inflation, the big recession gauge to look at is the 2-year Treasury bond yield to the 10-year Treasury bond yield. So the 2-year interest rate is trading above the 10-year. Historically, when that happens, that actually causes a recession. Now, I will throw some good news out here. If you look at the inventories that retail companies reported, Target, Walmart reported yesterday, they're having a whole bunch of products on their shelves that they can't sell. I anticipate when we get closer to the Christmas shopping season, you're going to see some very, very dramatic price cuts in those products they have to help move them off the shelves. That's the good news on prices coming down. But unfortunately, those retail companies are going to take losses on those products, and I have a feeling they're going to be firing a lot of people come the first quarter of next year.
And if they're getting rid of the off-season inventory before the Christmas shopping season, does that mean when they bring in the goods to be sold at Christmas time, that'll be lower too, or will they hike them even higher?
Well, here's kind of the rub on that. They may not want to buy a bunch of stuff for the Christmas. It's probably already been ordered, and they're trying to actually cancel orders because people aren't buying them. So when Christmas does come here, they may sell a lot of that extra inventory, but they still have plenty of it there for next year.
Well, if I'm understanding this correctly, does that mean there's going to be some scarcity of some Christmas items? Like they were warning about that last year, as a matter of fact, that you better shop early because you may not be able to find the presents that you want for the holiday season.
Well, and it was with every Christmas shopping season, there's always some things that are hard to get. But this Christmas shopping season, there may be too much of the stuff on the shelves, and they'll have a lot of discounts on it.
All right, so is there any way that the Fed and the Biden administration could have done things differently rather than subjecting us now to more interest rate hikes and higher prices and higher inflation? In other words, was there something they could have done better earlier that wouldn't have such a drastic effect on our pocketbooks?
Multiple things. They could have stopped doing these lockdowns. All the lockdowns did was increase, what they call pent-up demand. The failures on the supply system, the port overcrowding, and then not to mention from a longer term basis, the government for years has outsourced all of our stuff. So when China locked down its economy, the bulk of the products that come to the United States, we couldn't even get them from China because they weren't even being manufactured. So it's just a continuous loop of bad policy mistakes over decades.
Well, if you hear the interviews on TV now and in newspapers and in the media, and all the Biden administration officials are apparently trying to redefine the definition of recession. Now, is that just smoke and mirrors now? So to try to get away from admitting that we're in a recession or soon to be in a recession, or is there some logic to that we're not really defining it correctly?
Well, no, Larry. Ever since going back, when I went through my first economics class back in the early 1990s, it was, 2 back-to-back quarters of negative GDP is a recession. That's the way it's always been since the beginning of time. And odds right now favor that they're going to have the 2 negative quarters. They may or may not have it, but they're trying to say it's not a recession. Could be a mild recession, could be a bad recession, but the actual textbook definition of recession is 2 negative back-to-back quarters.
All right, so when are we going to know if there are 2 negative back-to-back quarters?
I believe the GDP numbers for second quarter come out, I believe, tomorrow.
Tomorrow. So as soon as tomorrow is this week, depending on when people are watching this, we're going to know for sure whether we have 2 negative hits in a row.
Right. Yep.
Yeah. So where do you see this heading? It's a question I keep asking you, but everything is in such flux and dire straits economically. I mean, is there any light at the end of the tunnel anytime soon?
Well, there is. If you look out for people that, and this is for like hedge funds and more professional type investors, they're placing bets in the first quarter of next year that the Fed will actually start cutting interest rates. Now, I've even seen speculation they may even start another quantitative easing program because the economy will be picking up steam into an actual recession come the first quarter of next year.
Well, how bad could it get before that?
I don't think it's going to get extremely bad in this situation. Now, for stock investors, it might because stocks are still fairly overvalued. But the Fed pumped so much liquidity into the economy over the last 2 years since COVID. A lot of that liquidity is still there to kind of cushion the fall. So banks' balance sheets are in really good positions to handle a recession. Where my concern is the government's taking on so much debt. By my estimates, come roughly 2030. The interest payments alone for the United States government, they would be writing $1 trillion interest check out every year just to make the interest payments on by that point, 50-something trillion dollars in debt.
So to say long term, this is simply not sustainable.
Correct. If you look through history, you're like, if you look at 2008, the seeds for 2008 were actually laid in 1999 with the repealment of the Glass-Steagall Act. If you look at the Great Depression, the problems from the Great Depression, you can track all the way back to World War One.
All right, explain the repeal of the Glass-Steagall Act. That used to prevent banks from merging themselves between commercial and investment banks, correct? Banking, correct?
Correct. So to kind of give you an idea, back before the Great Depression, if you went and put your money in a bank, that bank actually had the ability to go out and invest it, like in stocks, bonds, and all that kind of stuff. So when the stock market crash occurred in the Great Depression, the money that you thought was sitting safely in a bank actually went bankrupt in stock investments. So that created the repeal. That created the what's called the Glass-Steagall Act. It was basically to keep banks and the brokerage divisions as two separate companies. In 1999, the Glass-Steagall Act was repealed under the Democrats. Bill Clinton was president in 1999, and that basically took all the safeguards and all the safety nets that basically created 2008. They were basically removed from the playbook, and hence 2008 occurred.
And that's when we have the bubbles and everything, correct? Where things were overplayed and then they came crashing down in a number of fields.
Well, yes, it's leverage and bubbles. So, like with the housing market, you had companies, banks that were going out there and leveraging up. They would take, they get $1 million in deposits. They would have $40-50 million worth of homes on their books, and nobody wanted to buy them.
Yeah. All right. Last question. Do you see any way that the Biden administration could pull this out of their hats, so to speak? Anything sleight of hand or anything actually real that they could do to turn around the economy in any significant manner before the November midterm elections?
Not really. It's too little, too late. I would say that I know that Joe Manchin has agreed to sign off on his version of the Build Back Better plan that came out this afternoon. There's some things in there that's going to cut that's going to basically cut or increase taxes for the super wealthy. There's some things in there about lowering, prescription drug cost, but still just a little too late. Usually when those kind of bills get passed, it normally takes anywhere from 6 to 10 months for the actual bills to actually work their way through the economy to where people actually start filling them.
So the way it looks now, for all intents and purposes, the Democrats are heading into the midterm elections in November with the economy still in bad shape.
And by my estimates, the economy will actually get worse because at the last Fed meeting, that 75 basis points hadn't even fully worked its way into the economy yet. People will just start feeling that 75 basis points from last month. They'll just start to feel that here in the next 2 or 3 weeks.
All right, and actually one final question now. People are talking about the red wave because of the shape of the economy and other disruptions in American life. Do you see for sure a red wave and the Democrats being swept out of congressional dominance?
I think I'm looking at a massive red wave. The only thing that I have as a possible concern to stop them is that your social networks are all basically controlled by liberals. So the news you get off your computer, the news you see on TV is dominated by liberals who have suppressed the Hunter Biden scandals. They've suppressed, things about Hillary Clinton. So that's my biggest concern is what degree do those liberal social networks go to suppress information?
But even if they suppress that information, in terms of pocketbook issues, no matter what the propaganda and the narrative may be in the mainstream media about how great things are, I mean, most people, even traditional Democrats could see the shape of the economy when they go shopping for anything, right?
I would agree with that, Larry, but I've also discovered on talking to some of my Democratic friends that they sometimes you can fool some of the people all the time. I just had a discussion over this past weekend. We was talking about a recession I was with a liberal, and they're like, and it came up same thing. Mark, the definition of recession is wrong in this situation. I'm like, how's it wrong? because they've been told that. There's some people that just will not yield. They bleed blue.
And that may be enough to keep the Democrats in power.
I doubt it, but you can fool some of the people all the time. I've learned that. I have definitely learned that talking to some liberals.
All right, Mark Collinsworth of Vera Global Capital Wealth Management. Thanks for being with us, and we're going to see pretty soon how this is all playing out. So, Mark, thanks once again, and thank all of you out there for staying with us. And we'll have another podcast for you very soon. Thank you.
Anytime. Thanks.